Welcome back to Valuation Street. We're doing another deep dive today, and this time we're focusing on RTX Corporation. You probably remember them as Raytheon Technologies and what's happening in the wider aerospace and defense world.
That's right. We're digging into their latest Q1 2025 earnings call, plus other public info.
Yeah, and the mission really is to cut through the noise for you, the potential investor. We want to give you a clear picture of RTX's financial health, where they might be heading, and, the challenges they and competitors like GE Aerospace and Safran are facing.
Okay, so we'll be looking at things like organic sales growth.
Right, their core growth.
Exactly. And how the different parts of the business are doing, Collins, Pratt Whitney, Raytheon.
Right.
Plus, the impact of potential tariffs, which is a big topic right now.
And of course, the dynamics in commercial aftermarket versus defense. So let's jump in. Q1 2025 for RTX looked, pretty strong on the surface.
It did, yeah. They reported 8.0% organic sales growth overall. That's a healthy sign.
Okay, 8%.
Yeah.
And profitability.
Even better, perhaps. Segment margins expansion of 120 basis points, so 1.2 percentage points up. And that was across the board contributions from Collins, Pratt Whitney, and Raytheon.
Right, seeing it across all three. Collins doing avionics and interiors, Pratt with engines, Raytheon in defense. That suggests something's clicking, doesn't it? What drove that?
Well, a huge driver was the commercial aftermarket, spare parts, maintenance, that kind of thing.
Right.
That was up 21% organically. 21%.
Wow. So planes flying more, needing more service?
Pretty much.
Yeah.
Air travel recovery plus maybe an aging fleet needing work.
Yeah.
And that's typically high margin business, so it really helps the bottom line.
Okay. And other areas?
Commercial original equipment, so parts for new planes, that was up a more modest 3%. Defense sales grew 4%, so growth everywhere, really.
And they mentioned free cash flow, too.
Oh, yeah. Big improvement there. Over $900 million better than Q1 last year, so cash generation looking much stronger.
Okay, let's talk engines. Pratt & Whitney and the GTF program. That's been a closely watched area, given some earlier issues. What's the update?
Yeah, crucial updates here. First, MRO output, that's maintenance, repair, overhaul for the main GTF engine, the PW1100. It's up 35% year over year.
35%. That's significant.
It is. And 14% just since the last quarter. They're saying they're on track for over 30% improvement for the whole year. This is key to getting those planes that were grounded, the AOGs, back in the air faster.
Right, reducing downtime for the airlines?
Exactly. And second big thing, the GTF Advantage engine got its FAA certification.
The upgraded version.
Right. It promises potentially up to double the time on wing before needing major maintenance. Deliveries to Airbus should start later this year.
And for the existing engines?
Good question. They're working on an upgrade package. The aim is to bring like 95% of those durability improvements from the Advantage engine into the current fleet during regular shop visits. That's targeted for next year.
Okay, so that sounds like a plan to address reliability concerns for the whole GTF fleet over time. Smart. Now let's pivot to defense. Raytheon and the LTAMDS program.
Right, the lower tier air and missile defense sensor. Big news here is that the prototyping and development phase is done.
So it's ready to go.
Pretty much transitioning to production and deployment now. This thing offers 360-degree performance, and they say more than double the tracking range of the current Patriot radar.
Wow. And deployment.
Deliveries to the U.S. military happening this year and next, then European customers after that. And importantly, it integrates with the existing Patriot system, which, is used by 19 countries. So it's a major upgrade for a widely used platform.
Okay, makes sense. Now, the elephant in the room for many global companies, tariffs. RTX gave some numbers on the potential hit.
They did. They gave estimates of the direct pre-tax operating profit impact if the current tariffs stay in place for the rest of the year. This excludes secondary effects, mind you, like changes in customer demand.
Got it. So the direct hit.
Okay, so roughly $250 million related to Canada-Mexico trade. Another $250 million potentially from China tariffs.
Okay.
Then tariffs on goods for the rest of the world, assuming a 10% rate, maybe another $300 million. And finally, steel and aluminum tariffs, around $50 million.
That adds up. When would that impact hit?
Mostly in the second half of the year, they think, as they sell through existing inventory that wasn't subject to the tariffs. The cash impact might actually be a bit larger just due to timing of using up inventory and how duty drawbacks work.
Right, the refunds on duties paid. So facing those numbers, what are they doing about it? Any mitigation strategies?
Yeah, they outlined a few things, using regulatory tools like temporary imports under bond, duty drawbacks where possible, maybe using free trade zones more.
Okay.
Also looking at contractual stuff, pricing actions with customers or suppliers, and then operational changes, finding alternative suppliers, maybe shifting assembly locations. It's a multi-pronged approach.
We'll have to watch how effective that proves to be. Despite those tariff worries, though, their order book looks pretty full.
Oh, definitely. The backlog is huge. $217 billion at the end of Q1. That's up 8% year over year.
And how does that break down?
It's about $125 billion in commercial orders and $92 billion in defense. So a really strong pipeline gives them visibility for future revenue.
And the outlook based on that.
They seem cautiously optimistic. They expect continued strength in that commercial aftermarket, though it does depend on planes flying and, consumer sentiment. And they see strong demand for new planes continuing, given the big backlogs at Boeing and Airbus.
Okay, let's quickly run through the segment's Q1 performance again with the adjusted numbers. Collins first.
Right. Collins Aerospace. Sales were $7.2 billion. That's up 9% organically. Operating profit, $1.2 billion. And that margin expansion was 130 basis points, really driven by that aftermarket strength. But defense was solid, too.
And their outlook for the full year, excluding tariffs, of course.
Excluding tariffs, yeah. They're guiding for low single-digit adjusted sales growth, mid-single-digit organic growth, and operating profit up between $500 and $600 million compared to 2024.
Okay. Pratt Whitney next, the engine maker.
Pratt Whitney. Sales, $7.4 billion. Even stronger organic growth at 14%. Operating profit, $590 million, also with 130 basis points of margin expansion. Again, commercial aftermarket volume and mix were key.
Deliveries.
Delivered 250 large commercial engines in Q1 and 518 engines from Pratt Whitney Canada for smaller aircraft.
And their full-year outlook ex tariffs.
High single-digit growth for both adjusted and organic sales. Operating profit growth expected between $325 and $400 million versus last year.
Got it. Lastly, Raytheon, the defense side.
Raytheon. Sales $6.3 billion, up 2% organically. Operating profits $678 million. With 120 basis points margin expansion, they cited favorable program mix and productivity gains.
How are bookings?
Bookings were $4.4 billion in Q1. That gives a book-to-bill of 0.7 for the quarter, which is a bit low, but the rolling 12-month book-to-bill is strong at 1.35.
So orders outpacing revenue over the past year. Any big wins?
Yeah, over $750 million for Netherlands air and missile defense was a highlight.
And their outlook?
Ex-tariffs. Low single-digit adjusted sales growth, mid-single-digit organic. Operating profit growth of $150 to $225 million versus 2024.
Okay, helpful to have those segment details. Now let's bring in some competitors for context. How did Safran look in Q1?
Safran also had a strong quarter. Revenue was just under $7.3 billion, up almost 14% organically.
Wow, strong growth there, too.
Yeah, especially in propulsion engines. That was up over 16% organically. A big driver was civil engine spare parts, up over 25% in dollar terms. Their services business, tied to engine flight hours, was up strongly, too, around 17.6%.
Interesting. LEAP engine deliveries were actually down slightly.
They were, yeah. 319 delivered versus 367 last year. But they said that was offset by a better customer mix, presumably higher value configurations. Also, they got the EU green light for buying Collins actuation and flight control business.
Right, the divestiture from RTX. And what about GE Aerospace?
GE Aerospace, also looking strong. Q1 orders up 12%, revenue up 11%. And like RTX, they're talking tariffs. They estimate they can mitigate the hit down to around $500 million using similar strategies, duty drawbacks, foreign trade zones.
So everyone's grappling with this tariffs issue.
Pretty much. And you hear both RTX and GE emphasizing how important the U.S. aerospace and defense trade surplus is, arguing for keeping things duty-free if possible.
Makes sense. Stepping back for the big picture, what are some key industry dynamics investors should keep in mind here?
Well, a few things. One is definitely the increased defense spending focus in Europe. That's a clear opportunity, especially for Raytheon's missile defense systems like LTAMDS.
Okay.
Another is the importance of long-term service agreements, LTSAs, in the engine business. Companies like RTX, GE, Rolls-Royce, they lock in decades of high-margin service revenue this way. Over 90% of Rolls-Royce Trent engines are covered, for example.
Provide stability.
Exactly. Then there's RTX's own competitive advantage, their economic moat. It comes from things like patents, brand recognition, but also high switching costs. Once an airline or military integrates Collins avionics or Raytheon missiles, it's hard and expensive to switch.
Right. That moat seems pretty wide, especially for Collins and Raytheon.
I'd agree. Pratt Whitney also benefits from the long-term trend of more air travel. And finally, in defense, you're seeing specific investment boosts in areas like missile defense tech to counter new threats like hypersonics. That plays right into Raytheon's strengths.
Okay, so pulling all this together for someone considering an investment in RTX, what are the main takeaways?
I think you have a few key points. The mix of commercial, aero, and defense definitely provides some balance and resilience.
Now, less exposure to just one sector's cycle.
Right. The aftermarket business is clearly a strength, high margins, recurring revenue. But that tariff impact is a real risk to watch. How well can they actually mitigate those costs? That's crucial.
And operational challenges.
Definitely. Supply chain stability is always a factor. And can they ramp up production fast enough to meet demand, especially for new commercial planes and engines? That's key.
But the long-term picture.
The long-term growth trends in both air travel and defense spending still look pretty solid. Those are powerful tailwinds for RTX and the whole industry, really.
So after this deep dive, it feels like we're looking at a robust company in a pretty complex industry, wouldn't you say? RTX showed solid Q1 results, especially that aftermarket engine.
That's right. Strong performance, but you've got those potential headwinds. Tariffs are the big one, plus supply chain stuff still lingering. You have to weigh those risks.
But the innovation seems to be there, right? The GTF progress, the LTMS system coming online, and that massive backlog points to future demand.
Absolutely. Those are definite positives. The backlog provides a good cushion.
So for you listening in, trying to make sense of this for your own investment decisions on Valuation Street, understanding these moving parts, the growth drivers, the risks, how RTX stacks up against competitors, it's all pretty essential.
Yeah. Hopefully this deep dive gives you a good starting point. We definitely encourage you to look deeper into the financials, read other industry analyses, and keep an eye on those global trade and defense spending trends. You need to form your own conclusions.
Exactly. So what's the biggest thing that stands out to you from all this? And maybe more importantly, what questions does this raise for your own research going forward? Something to think about.
Wondering how we quickly synthesize info for this podcast? We use AI. You too can boost your productivity with AI thanks to our sponsor, brainybeapp.com. Get instant answers and insights using top AI models like Google's Gemini, Claude 3, and the latest from ChatGPT. Stuck on a tough calculus problem? Snap a picture for an instant answer from BrainyBee. Need a deeper understanding? Ask BrainyBee for easy step-by-step explanation effortlessly. No subscriptions. AI for business, AI for fun. Skip the subscriptions. BrainyBee is #1.